Hello, everybody, and welcome to the Advanced Market Smith webinar today. Today, we're going to talk about how to handle stock price gaps. First, a quick introduction. My name is Arusha Pierce, and I'm one of the product coaches here at MarketSmith. And so today's objectives. So what I want to do today is really go over the importance of price gaps and make sure you all know the differences between the price gaps. And then finally, that you all understand the risks with buying some of these gaps. There are very specific gaps that I will only consider buying if it has great fundamentals and a great story. So I want to really convey that throughout this webinar, that gaps are very risky and there's only a little exception where we will consider buying. Now, I just want to make sure you guys are all clear with the webinar software functionality. On the right-hand side, top right-hand side of your panel, you can ask us a question. Just use this little window field, and we will make sure to answer it by the end of the presentation, okay? And also a quick disclosure here, anything that I say is for educational purposes only, and please don't take it as a buy or sell recommendation. Okay, so I wanted to start off with really what we call the stock market's great paradox, and this is from the How to Make Money in Stocks book. And quite simply, what seems too high in price has a tendency to go higher, and what seems too low generally will go lower. Okay, and this is why we buy stocks coming out of bases when they are going into new highs, and avoid stocks that are going into new lows. And really, with gaps, it's kind of taken to that extreme, right? They're even more intense. And so I just want to make sure, since we have a lot of people on this webinar, that we are all clear on what a price gap is. Okay, so pretty much one day a stock will close and it'll end right here, and the next day it opens up much higher. And there's this gap in between, and really there's this big gap because no trades have taken place in this area. And there are a lot of reasons why this can happen. And quite simply, they can be created because of a reaction to an earnings report, okay, or some unexpected fundamental news. There's new information that just came into the marketplace, okay? Now, a lot of times, there are plenty of gaps created during a stock run. That's due to emotions. People get too excited about the stock, or on the same way to the downside, people start fearing that the stock is going to go to zero. So you will see these gaps appear as the stock is plummeting or as the stock is rising too much. So you want to be really aware what type of gap that is. And then finally, you will also see gaps on if a stock gets acquired, right? And now these ones you really can't do much. A lot of times they're just bought and they'll go sideways. But you will see that kind of price gap. So you want to make sure, or even on a dividend, things like that, you will sometimes see a gap on certain charts. We will adjust for that, though. We want to make sure the gaps that you see are actually how the stock was traded at that point. Now, there are certain price gaps that are that you want to focus on, and the reason why is because they are conveying some new information to the market. We like to call it a sea change in sentiment. A stock was doing pretty well before, and all of a sudden some great new news comes out, and the stock gaps up, and all of a sudden there's a huge demand for the stock. Now, a lot of times that comes on an earnings report, right? The company will come out and say, hey, our quarters are great. It's going to get even better over the next few years, right? And all of a sudden Wall Street realizes that they don't have enough of that stock, and they just start buying it up, and it creates a price gap. That's the kind of behavior that we're looking for, so we'll go more in specifics with that. That's called a breakaway gap, and really a lot of it is a fundamental catalyst in the stock move. When the analysts go in there, they run their models, they enter the new numbers in, the target price is much higher. Okay, and so there's either the N in Can Slim, something new has come out with technology or a new sale or something, and a lot of times, once again, it's on that earnings report. Now, we will consider this as in that those rare occurrences or rare cases where the stock has everything, huge fundamentals, huge story, all of that, we will consider using this as an advanced buy point. Now, this is for experienced investors. You have to be really been trading at least a few years, in my opinion, before you can even consider trying some of the stuff that we talk about here on this webinar. Now, the reason why I got really interested in price gaps was back in 2005 with Google. Okay, so I was like most of you on this webinar right here. I was trading on my own, and I was a subscriber to our old Daily Graphs product. And here's Google. I was following this stock, and they report earnings, and the stock gaps up. And so I didn't have pattern recognition at that point, unfortunately. So I just see this big gap up on the stock, and I'm like, okay, I have no idea how to handle this stock, but I see it's gapping up on huge volume at this point, and I think it's breaking out. Now, I think I probably tried it back here too, and I got shaken out of it. So that was probably in the back of my mind. So I see this again, and I'm thinking, you know what? I'm going to wait on this stock because right now it's too high, and I know gaps, and most gaps will fill. Eventually, all of them fill. So most gaps are filled. I'll wait for it to pull back, settle down, probably fill the gap, and then I'll get into it because I really like the story. You know what? I'm still waiting to get in from this price point right here. And so this is the power. This is really kind of what made me a little bit more aware that, hey, wait a minute, you know, some of these great stocks have everything, and now they report earnings, they're going to react a little bit differently. So I have to learn how this is, because this was a huge mistake not to buy it, looking back at that point. And of course, we all have to learn the hard way. I still think about that at that time, because here was a stock that I was following very closely, and it was one of these stocks. And so you're really only going to apply this on those special kind of stocks that you think are a super leader in the market. Now, 6 months later, here's Google setting up again in October of 2005, and they report earnings, and a gap up again out of a pretty nice base on huge volume. Okay, and so this time I tried it. And this time I was able to catch some of this ride, and so that at least confirmed. So I didn't necessarily go out and buy gaps left and right after that April experience. I still waited and really applied it to those few stocks that I was looking at that I really knew their story, and I thought that they were a game changer. And we know back then that Google was a game changer. All right? They were completely disrupting the whole ad and marketing industry. And of course, they're already dominating search, and now that they're adding this and just generating so much revenue. And so they were changing everything at that point. And so those were really the only times I would consider this kind of point. Now, I just want to make sure we are all clear on the dangers of this, because while that's a great story, I have plenty of other stories where I've tried these gaps and I've gotten run over by them, and I would have gotten really killed on it if I didn't protect myself. So the key is you have to know what type of gap you're buying. Okay, most gaps, they are not going to be good gaps to buy. All right, most of them are going to be signs of exhaustion if they're on the way up. All right, and they will fill in quickly. So you stay far away from those. I'll show you some examples of that. You have to have an exit strategy. If you don't have an exit strategy, you will get caught, and you will be a deer in headlights at this point. They go up fast, they come down faster. And so you're really asking for it if you don't know what you're getting yourself into. And like I said before, you only try those few breakaway gaps that I'm going to show you right now. After a few years of experience, you have to prove to yourself that you're going to cut your losses. There are points where you just cut it. All right, you make your plan, you get into the stock, you know your exit strategies. It's down that 7%, 8%, whatever, you cut it. All right, and once you get through that, once you're not hesitating at that point, then you can consider something that's definitely a much more advanced, much more risky type of entry. And so to illustrate this concept, this is a stock I did try a couple of years ago. It gapped up, and I was like, oh, okay, you know, this looks like a pretty good breakout here. This is actually in the blue area too. All right, so it not only was gapping up, it was in this blue area, so it wasn't too extended. So I tried it. It wasn't the greatest base. So I adjusted for the risk by going in smaller at this time, and I had my exit strategy. Okay, if it undercut this low, I would be out of it. I was not going to play around with this, and I'll show you a few more examples where I'm putting that. But in this case, remember, with gaps, the gaps should really work quickly. But the gaps, if they're not going to work, they will fill in quickly, and so that's exactly what this stock did. It filled in super quickly. And if I didn't have my exit strategy, and if I hesitated at that point once I hit that exit strategy, I would have gotten killed on this. All right, so this is the type of stocks, the type of entries you're playing with. A lot of them are not going to work. Yeah, if you're going to try them, you try them on a very rare stock, right? And probably a few times a year maybe. And if they don't work, you're out. No questions asked, because you are taking much more of a chance at this time. Now, another danger of buying a gap is that you really have to know what gap you're buying. So that's what we're going to do. We're going to go through each of these gaps. All right, and because most of them are going to fill in quicker than others. For instance, here's a gap. Do I buy it here? Right? And this is much different type of gap. This is more of an exhaustion gap. If you bought it here, you would have seen it fills quickly. Oh, there's a little gap there. What if I buy it there? Oh, it's going to fill in quickly, right? And in fact, there's a gap down here, and it eventually fills in quickly. So the bottom line is most gaps will already fill in quickly. And all gaps, eventually, all of them get filled, okay? The market will come back and start trading that area where there was no trading before. So I just want to make sure we're all clear on the dangers of this. It's for that rare amount. So let's get into the types of gaps, because you all have to be very clear on this before you ever attempt this, okay? And so now there are really three different types of price gaps. There's a breakaway gap. Okay, so these are the ones that we're going to focus on. These are the only ones that I will consider for those rare stocks that have everything. There's a continuation gap. There's an exhaustion gap. Okay, those are really the three. Now I added a fourth one here, which is the gap down. And really all this is, it's a breakaway gap to the downside, right? It's gapping out of a consolidation to the downside. The reason I put this in here is because, you know what, we're all going to get caught in these gap downs from time to time. You have to know what you're doing, and really you're out immediately. No questions asked. I'll show you some examples. Now, let's start off with the breakaway gap, because this is the one that is the one that you really want to start getting comfortable with. And after those few years of experience, now you can start trying it and get experience in this. And all it is, it's just a gap from a consolidation or a chart pattern. Guess what? It's a breakout. It's just a more powerful breakout on huge volume. Okay, so we're sticking with those same concepts that we talk about in a lot of our other webinars, right? We are looking for those great stocks with fundamentals, that beautiful chart pattern, and the powerful breakout. Gaps just make it a little bit more extreme. Now, ideally, it's going to occur at the beginning of a trend. So first, second stage basis, that's where you generally want to stick with, unless it's a company you really like, or unless you really know what you're doing. Okay, so here is one example. This is MasterCard back in 2007. Note, this is a base on base. Okay, so here's your consolidation. Here's your base. Okay, and so it built its base, tried to break out, shook everyone out. It wasn't its time. Built a tighter base, kind of went nice and sideways here too, right? And then it reports earnings. Okay, so it gaps up on huge volume. There's really not much difference. The one big thing is that here's your ideal kind of entry point. So it is extended at this point. Okay, so that's the one thing you're going to have to be aware of right here. But with earnings, there was a sea change in sentiment and a reaction for earnings. So I first want you to just get the visual on what a breakaway gap is. Okay, there is a consolidation, and now breaking through that resistance area very powerfully. Okay, there's no question at this time that there are new buyers coming into the market. Okay, so just get that visual, get that behavior down. Okay, and as you can see here, this one ended up doing pretty well at this point. It went on a pretty good run. Maybe you take your 15-20%. You're not going to catch the entire run, right? But it gives you a chance to get into and catch a little bit of it. So that's just right now by definition a breakaway gap. And guess what? There was another breakaway gap over here too. Formed base, gaps up. Okay, so that's a breakaway gap. Now here's another example of a breakaway gap. Green Mountain Coffee Roasters are actually now Keurig Green Mountain. That's going to take a little while for me to get used to right there. But once again, a base, a gap up, which is really just a more powerful breakout on big volume. Okay, and this one, it really didn't go that far. Okay, so sometimes the gap ups are very powerful in the beginning, then they need a month or two to consolidate before taking off. So, you know, a lot of times you're not going to always have to buy them that day. Okay, but you add them to your watches, you keep a close eye on it, because they may even give you a lower risk entry point, or maybe even form another base. So that's the breakaway gap. I just want to go over that visual right now with that. Now let's go with the continuation gap, because the continuation gap and then the exhaustion gap, they're very, very similar here. Okay, they're very difficult to tell in real time which one is which. So with the continuation gap, this is also known as a measuring gap because it's halfway through its move. And a lot of time, this gap, it just signals that, hey, this trend is just going to continue to go. Of course, in real time, it's very difficult to know at that point. You may only know a couple of weeks later that, hey, this thing is actually holding. So here's a continuation gap. Okay, big gap up. Huge volume. There's your base. Wait a minute, this base is really extended at this point, right? So I don't care. You know, at this point, this is why I'm saying you have to know what type of gap you're getting into, because this one has a lot more risk. There, first of all, it's already probably 30% before this big pop, because right there I see 68%, so it's already gone on this big run. Jumps up again, and there's so much enthusiasm to it that it's very difficult to know where this thing is going. It could easily come back in. Okay, so you have to be careful with this. It is extended from the last base, and in this kind of case, I will never try it at this point, okay? But you know that, okay, this could be a continuation gap or an exhaustion gap. I'll show you both of them. They look identical at this point. And so here, this one is, as we know, in hindsight, we know that this is a continuation gap. Notice how it jumped out, and it settled down, okay? So the fact that it didn't undercut and start filling, remember what I was talking about filling in the beginning? It didn't fill the gap, and it was able to gather its strength and then a month later take off. Okay, so you're adding it maybe to your watches and watching it closely over the next month to see how it's hanging in there, but you're not trying it on that day. Now, FleetCor, another continuation gap right here. You can see it gapping up way up here on big volume. Okay, now there's a problem here. Here's the base right here, and this thing is super extended. Okay, so once again, you can't try this one. You just know that this could be a continuation gap or not, all right? But you don't try it on this day. And now, of course, this one, it did end up working, but you have to always manage for your risk, okay? But this is how a continuation gap is. They'll jump up, and they're just really starting the second part of their move. Now, finally, one more example here, Priceline, another super extended move right here where it gaps up, probably on earnings. And here's the last base, but take a look at this big run right here. So it's running up here. You have to be very careful of this too, okay? But in the end, it turned out to be a continuation gap. So you're adding these to the watches. You're keeping an eye on to see if it gives you a safer entry point, a little lower risk entry point. Now, the reason why I'm going through all of this is because continuation gaps are so difficult to distinguish between an exhaustion gap in real time. Now, exhaustion gap is very extended, kind of like what we were seeing in that continuation gap. And with exhaustion gap, once again, there's too much enthusiasm, and guess what? Probably it's being talked a lot about on TV, or you're seeing on the magazines. Now, this is a sell signal at this point. In fact, even the continuation gap, if I saw that, if I was in it, I'd probably start selling some of it or protect myself and put a stop below the low of that. For instance, let me go back here. Say I was in Priceline here, right? Say, and now it gaps up at this point, and I'm up big on it. I'm putting a low at this point to protect myself, at least for half the shares, okay? Because I don't know if this is a continuation gap or exhaustion gap. So there's just too much enthusiasm coming in at that point. And the bottom line is for any of these, for an exhaustion gap, they will get filled quickly because they go up fast, they come down faster. So here's Workday, all right? And so now take a look at this and tell me what the difference between this gap up is than a continuation gap, right? It's impossible to tell at this point, right? You still have a gap up on big volume. So all you know at this point is that it should not take out the low, okay? Once again, there's a lot of enthusiasm on TV, and so you don't know at this point. You just know, okay, it's gapping up. There's a lot of enthusiasm. Usually when there's enthusiasm to the upside, yeah, it probably needs some kind of rest. And so the one thing I know is that it should not undercut this low, okay? So that's all you know. So you know where your kind of exit strategy. So say you bought a Workday out of this base right here. Now you're up big on it, and it's gapping up. What I generally do is I'll move up a stop up here, or a mental stop, or if you're not watching the market a lot, then you can put an actual stop there for at least half the shares. Okay, a lot of times if it's this much enthusiasm, I'll take some off the table and then put the stop on it. Okay, but there's a lot of excitement at this point. Now, as we saw with some of this continuation, it could continue to go, but you don't know at this point, so you want to protect yourself. But the bottom thing that it doesn't matter whether it's a continuation gap or an exhaustion gap, it should not take out the lows of that gap. All right. So here is Monster. Note there's your base right here and another gap up right here. Big volume coming into it too. Okay. Now note, base breaks out, jumps up, puts another nice base and breaks out. So it's gone on a pretty big run right here from $50. Now it's at $170. It's tripled at this time. Okay, so once again, you don't know. Maybe it goes up to 360 from here, right? Maybe it is a continuation gap, but you don't know. All you can do is just put the low right here. You just know that it shouldn't undercut this or it's going to fill that gap. And of course, the next day, so you don't try to this. Of course, the next day, it's gapping up, right? And sometimes these exhaustion gaps, they'll get more ridiculous. Okay, when they go up fast, they come down faster, but sometimes they go up really, really fast, as you can see here. So much enthusiasm. Now, here's the problem. At this point, if you don't buy it, Monster, on that day before, you're dying here, right? You are going, oh my God, what have I done? I missed out on 24 points. Why didn't I just buy it? I don't care. I'm just buying it today. Monster, oh my God, everyone's drinking this drink. I'm just buying it today. And you have to be careful of your emotions because they are going to really get you in at the stock at the wrong time. And so here's that point at this time, right? And so you're just buying right at the top at this time. And you know what's funny is that it did correct quite a bit, and it did even go into newer highs. And sometimes they'll just do that, but usually when this happens, when you see that kind of move, you know that okay, it needs a rest. I don't know how much of a rest it needs, but it needs a rest because too much enthusiasm is coming in. It's gapping up too many times, and so it's exhaustion. Anyone who wants to get in at this point will have gotten in, right? And so at that point, who's there left to buy? And so you have to be careful of this and getting too excited, especially when it's gapping up after a big run. Now here's another example, Broad South, going on a big run, huge gap up. Okay, and this is a clear exhaustion gap. Of course, at this point, you don't know, but you do know that it went from $10 to $50. It's gone up on an absurdly big run. Okay, so worst thing, at least put that stop below the low. And of course, here, it did even go, notice how it did go in a little bit higher, suck in more people. But so you know it needs to take a rest, just not how long a rest. So exhaustion gaps are not always the ultimate top. They're just telling you that it's getting tired. The stock is getting exhausted, right? And then it needs some kind of rest. So why try it at that point? Okay, so just get these kind of setups in your head. So when you start seeing them in real time, you'll be able to take a step back and go, okay, wait a minute. Is this the right type of gap or not? Most of them are not going to be the right type of gap that you ever want to try. And so now here's another example, Crocs. Once again, here, a big gap up. We don't know if it's exhaustion or not. You just know that it has gone a tremendous run. It's starting to get a little too excited. And it's up 68%, and there's your last base. And oh, by the way, these other two arrows that I put, these are all other tiny little exhaustion gaps, right? Exhaustion gap's not like a climax top always. It is just a sign that the stock is running up too fast when it gaps up, and that it probably needs a break. It jumped up a little bit here, takes a break. Jumps up a little bit here, takes a longer break, okay? So these are all just very subtle signs. These are not the type of gaps that you ever want to consider trying to buy. And, of course, finally, this was the ultimate, I guess, exhaustion gap for this stock, where it eventually got pretty rough. So now let's just go over the price gap down on this, because this is probably the most critical one that you have to get down first, because we are all going to get caught in this. And so you need to know how to react to this immediately from the opening bell. Okay, a lot of times it's going to happen on earnings. So if you are caught in a stock that's gapping down on earnings through critical price levels, you have to get out. You have to protect yourself. And I can almost guarantee you that once you do that, it's going to go up higher Without you, that's okay. The bigger thing is that you protect yourself at this point. Okay, so here's Cree in 2010. And so you can see a gap down. It built this kind of ugly base, reported earnings, gap down. Okay, not only below the 50-day, through the 200-day. Okay, look how big the volume is. Huge, huge volume. Okay, those are institutions just saying sell. Just get me out. All right, you don't want to be around when they're trying to get out. So when you see something like this, just get out. Let the stock prove itself again. Okay, major sell signal. This is, once again, we were looking at breakaway gaps to the upside. This is a breakaway gap to the downside. Okay, and so here, this is the point right here. It did get worse. Now, what's funny about the market a lot of times is they'll bring it almost all the way back up again. And so for those who held on, you know, maybe they got a chance to get out. Chances are they probably didn't at that point if they held through this, and then they got caught in another gap down, right? And so if you didn't get one signal here, here's another signal to get out, and this time it got worse, right? So they don't always go straight down to zero, but they are major signals that someone is trying to get out. Note the volume right here. They can't get out all at once. Here's Rackspace, big gap down. If you get caught in this, if you go into earnings, you get caught on this, opening bell, out. All right, so there's no argument at this point. This stock is in major trouble, and so protect yourself at this point, and don't wait around to see what's going to happen. And of course, this one got ugly pretty fast. Oh, by the way, there's another gap down right there. And here's Nu Skin. Nu Skin, this one was tough. You were for those who are in this, the news just came out just during the day, I think, and it gapped down. At this point, when you see it's like, oh my gosh, you know, look at this long trend now gaps down, major change in character. Don't wait around to see what happens at this point because they can always get worse. And it did get a lot worse for this stock. So now I want to finally go over how I handle the breakaway gap. Okay, and so remember, this is for those who've been doing this for a while and who have really kind of gone past that first obstacle of cutting your losses, not getting yourself into trouble. And so this is pretty much how I handle it. If a stock has great fundamentals, an incredible story, a really nice chart pattern, strong institutional support, and now has a powerful breakout, okay, and it gaps up on that powerful breakout, then I will consider buying it, okay? See how many ifs there are? It's a very, very rare thing that I will try. I will only try it for the stocks that I think are a game-changing stock in the market. Because hopefully, as you can see here, there's a lot more risk to gaps than not. Okay, most of the gaps will fill, okay? Now, worst thing you can do is, I think if you don't buy it, that's fine. Add it to your watch list. Keep an eye on some of these stocks. All right, but this is, I need all of these things. You know, for a normal kind of breakout, stuff like that, okay, I might kind of lean one way or the other. But if I'm going to buy super high like that, I'm going to require all of these things. I want it to be a super leader in the market. Now, I will use like 2 to 3% below the low of the gap as a strategy. And it's not like if it starts coming back in, I'm probably lightening up a little bit just to protect myself at that point. But that's the ultimate kind of thing. I'm not hanging around because as we saw in some of those examples, they will fill in very, very quickly. And it's not like a gradual fill in. It's just like a complete dump. It just drops very fast. Okay. So I don't want to get caught around with that. This is ultimate danger if you're hanging around too long when it starts getting into the gap. And then finally, I will always adjust my risk by buying fewer shares and holding and keeping a much tighter stop loss. I don't play around with these gaps too much. They should work immediately, or I'm not playing around with them. Okay, so here are some examples. Here is Apple back in 2012. Okay, here's one that I tried at this point. Notice the base on base. Okay, this was actually a later stage base too. But guess what? This was still a pretty big leader at this point. And they still have pretty good earnings and sales. And so I said, you know, it's Apple. It's worth taking the risk if I keep a tight stop on it. Okay, it gapped up after earnings. Earnings are another big thing. Pay attention to earnings. I really want earnings out of the way before trying something like this. Because at least then I know there's new information coming into the market. And if it reacts to that earnings and it's such a powerful move like this, the odds are a little bit more in my favor at this time. And if it's not, I cut my losses and run very quickly. So here's the gap up, huge volume. Now this is what I'm doing. I'm putting my stop below the low of that day. All right, and I'm giving it just maybe a little bit of room just in case of a shakeout. But it's not that I'm not going to hang around too much. Now this one was a little tough because it kept me around for like 3-4 days and did nothing. And so I was kind of biting my nails and going, oh dear God, is this thing going to start filling in the gap? Now it ended up working. And so if you catch a little bit of this, it's you're going to be pretty happy of it. Okay. So I keep a very, very tight stop on it and knowing that this should work pretty quickly. Now, it did undercut a little bit on that day, and so that's why and I think I sold out a little bit, saying, okay, let me protect myself, and once it was starting to hold, then I bought it back, okay? So that's how I handled Apple at that point, getting into it. Now, LinkedIn, this was a really kind of big breakout right here. It broke out already. I already had some shares at this point. So base, you see the base of gap up, this was after earnings. Now here's the key for this one, okay? Because that was the low, 140. The stock was at 150. I went in super small at this point, okay? I mean, that was 10 points right there. I was like, I can't write it down 10 points only to see if it's going to hold the low, okay? So you're always adjusting for the risk at this point. And so I went in a lot smaller. Now, of course, it went on its monster run, and it would have been nice if I went bigger, but I'm not going to play around too much. Remember, I'm not playing around that much with this. The risk was too high at that time. Okay, but the bottom line is, even if you don't get in at this point, put on your watch and say, hey, this is some interesting behavior here for the stock. Now, of course, honestly, at this point, you don't know. I mean, this to me looked like a breakaway gap. Theoretically, you could have argued that this was more a continuation gap. Maybe it got too excited. It could have been exhaustion, right? Because it was so far away from the base at this point. That's why I went in super small at this time. But the big thing was I thought that LinkedIn was a game changer at this time. I thought they were taking the whole job market. We've talked about it in the past. And so that I felt it was worth taking that risk, but I kept a very, very tight stop on it, and I went extremely small. Okay, notice it gapped up here again. I tried it here again and was not in for too long. Okay, so I got shaken out. And finally, here is Under Armour, base on base, gaps up. Okay, big volume. And so I took a shot on this and keeping a low on this, and I adjusted for that risk. All right, and once again, here's another stock that had a lot of things, and I thought this is another kind of game-changing stock in the apparel industry. Right, a lot of the younger generation, they were wearing Under Armour, and so I felt it was worth a shot here since it was after earnings too. And so this was a choppier ride, but at least I was able to get into a little bit of it. All right, so that's how I handle the breakaway gaps. They really are breakouts from a base. They're just a little bit more extreme, so I keep a much tighter stop to it. Okay, so now how do I find these potential gaps? Really, I keep it very simple. I click on this Stock Ideas button. So on the top right-hand side, now if you haven't started using this Stock Ideas button yet, just start using it. This makes everything so much easier in MarketSmith, and I'm clicking on this all the time. So I just click on this Stock Ideas button, and then I just click on the Up on Volume screen. Okay, the Up on Volume screen, it's going to bring back a bunch of stocks, but it's also going to filter out a lot of stocks that don't have the fundamentals in it. And so I like to run this a few times during the day. And so I'll go through those screens, and if I see one of the stocks that I'm familiar with gapping up at that point, then I'll consider at that point. Now, usually I'm not going to see too many surprises on this because the stocks that I'm following, I'm paying attention to earnings when they're reporting, and then I see the reaction after earnings. If they have a very strong reaction at that point, then I'll usually, especially if it's after the close, a lot of the stocks that I look at they report after the close. Then that night I'll think about, okay, how am I going to handle this in the different scenarios? But this Up on Volume screen is great. It's going to catch a lot of these stocks that are having these big moves. Now, Jason here in-house, he built this pretty cool gap up screen right here. It's not going to catch all gap ups, okay? So I just want to be upfront with that. But what it's going to do, it's going to capture stocks on big volume. There's 50% volume right here. Here's the criteria here. If you don't have a chance to write it down right now, watch the archive webinar on this and zoom over here and take a screenshot of this. But this is a cool one. Use this or modify it in your own way. But very quickly, it's you're keeping over $15. You're keeping it somewhat looser, okay? Not everything has to be perfect. You just want to make sure it has enough things to filter out the junk. And the volume percent increase, 50%. A lot of times when the stock reports earnings, the deposit earnings, that'll be way over 50%, as you saw in a number of those examples. And so that's it. That's really the formal presentation that I had. Hopefully this was helpful to all of you. And really, just really to recap this, please take the time to make sure you understand the gaps before you ever try buying this. So remember, you want to spend a couple of years just sticking it with just a normal kind of way of cutting your losses, okay? And then only think about this. But you need to make sure you understand the different types of gaps, because hopefully you've seen that most of the gaps are terrible to try to buy. Okay, they're very risky. They're just an easy way to lose money. And get in the habit of running the up on volume screen every day if you can, okay? And because you will see some interesting stocks either gapping up, or guess what? A lot of times, another reason why I love running this up on volume screen is you can see stocks starting to build the right-hand side of the basis that you might have forgotten about. And then finally, any stock that you see that looks pretty good, it's gapping up, just throw it in your watch list, track it, see how it works, get a feel for some of these stocks. If you're in a good market, they all will line up. Okay, and make sure you are in a good market if you ever try any of these to the long side. So you just need to make sure that they're all in your favor before ever trying some of these things. Okay, so here are some of the examples. What I would recommend is to use the change date feature on MarketSmith. Go through some of these examples and go day by day. See how they act. Because a lot of these stocks, they'll act differently. What you'll probably see in most of these, they were all in pretty good markets and uptrend. Okay, a lot of these stocks, if they try to gap out during a bad market, they're not going to get too far before coming back in. And all they're going to do is whip you out. They may not collapse, but a lot of times the best stocks, they may try to jump out after an earnings report in a bad market, and then they'll just come in and go sideways and then wait for a good market and then take off again. So you want to make sure you're in a very good market. Go back and study a bunch of these. This will really help you get it down. And this is exactly what I did after seeing that Google example. It's like, this is, they're just more powerful breakouts. The breakaway gaps are just more powerful breakouts to the extreme. That's all they are. We're sticking to the basics, though. So I'll hang around to see if there are any questions here. It looks like we've run out. We're a little over timers. So I probably shouldn't stick around too long, but I'll see if there's any quick questions you can answer. Of course, if we don't have time to answer your question here, here's the contact information, okay? You can always give us a call or send us an email. Our phone number is 1-800-424-9033. Our email is reachus@marketsmith.com, and we are on Facebook. Search for MarketSmith, and we are also on Twitter. Search for the Twitter handles W. Scott O'Neill or MarketSmith. Okay, so let me just take a look here if we have any questions. In the meantime, let me just put these stock examples back up to date, just in case you didn't get that. Okay, it looks like we have an example here. A question here, sorry. Is your stop loss still 7-8% on buying a gap up? That's a really good question. Yes, for the most part it is. So remember that example on LinkedIn where it was at 150 and the low was 140? When I was looking at it, it was just too much for me. That's why I went in really small. So let me just get a little bit, but I can't go in normally on this one. It just moved. The bottom line for that one, it just moved up too fast during the day. Usually I like to wait till the end of the day to see if they're going to actually hold their gaps. And so sometimes they just take off without you. The 7-8%, there's no negotiation on that. You never want ever. So regardless, any purchase you make, you should be making 7-8%. Usually I try to keep it 4 to 5%. 4 to 5% my stop losses, okay, for any stock. And so that's gaps included. I don't like to play around too much. If it's too extended, may buy a little bit and hope that it pulls back so I can buy more. Okay, there's another question here. Does it help to wait a few days after a gap up to see if it settles down before buying? Yeah. I think so. There are plenty of examples where that's the right answer. There are other examples where you just take off. So a lot of times I might not get my full position on that gap up. Let me buy some and then see or how it handles next. Like, kind of like that Apple example. It jumped up and then it kind of went sideways the next 3-4 days. So you could have just been slowly buying and just use the low of that first day as your exit strategy, right? The 2-3% below that as your exit strategy. Just don't let it drop too far down, okay? Okay, there's a good question here about gap ups as a result of earnings. Uh, Buying in after hours. Do you buy in after hours? No, I don't. I have tried it in the past. You know what happens sometimes? Sometimes it runs in after hours, and you're like, oh yeah, it's going to gap up, and the next day it opens up down, right? Or even in after hours, it runs up quite a bit, and then all of a sudden it just reverses instantly, and now you're down on it. So I don't play around too much with after hours. I wait. I prefer to wait till the morning of the next day to see. And then if it's a stock that I really like, I might buy some in the morning. I still prefer till the end of the day. And the downside is it's something like a LinkedIn where it just takes off. It opens up at 140 and all of a sudden in a half hour it's up at 150, right? So that's the downside. So as long as you're aware of all those scenarios, that's the biggest thing. So you can you can prepare and see what works for you. Yes, and Sonny, yes, you only use this strategy in an uptrending market and only for leading stocks. Thank you. That definitely summed it up a lot better than I did. Okay, Thomas. Thomas, I think I would need to actually see an example. Maybe give a call or something on that. It's a little too hard to visualize your scenario that you're talking about right here. Oh, okay. Look, you might have missed the beginning. With the acquisition, the gap up on cause of acquisition, there's not much you can do. I stay far away from it. They really don't trade after that too much. Maybe some might trade, but a lot of them, once they're acquired, they just kind of go sideways, especially after the whole thing goes through. But yeah, you're looking for a gap up due to a fundamental reason. Right? And a lot of times those fundamental news comes out on earnings or something. So an acquisition, things like that. No, there's nothing because they're just going to be acquired. They're being acquired for a certain price. That stock's being taken out of the market. It's a good question though. Okay, I think that's. Oh, okay. This is another one. Good. Thank you, Hassan. Ever buy gap ups on FDA approvals in biotechs? No, I don't. I do not. That's when that's unexpected news, but that news is all priced in at that point. Those reactions are instant. I mean, they'll run, but they really are instant. So a lot of times I stay far away. A lot of biotechs I stay far away, unless it's some of the more established biotechs that have been around for a while that have great earnings on sale. So a lot of those biotechs I don't touch. And so some of those I mean, there are a bunch of biotechs that didn't have earnings that went on insane runs last year. Yeah, I mean, I didn't play around with them. You don't have to play around with every stock, right? Now some of the other biotechs that did have earnings I was in, but the other ones, yeah, I don't try. Especially for biotechs, they're already volatile. I can't handle the volatility that well, and now biotechs it's a whole nother level. And now if you throw lack of earnings, where they're gapping up or gapping down based on an FDA approval, no, I don't try that at all. That is a good question though. Okay, I think that's it. All right, thank you all for joining us today. Hopefully this was helpful. And here's our contact information again, and definitely please feel free to reach out. Thanks.